A deductible is the part of a covered loss you pay before insurance contributes. In real life, it keeps small losses from becoming claims and shares risk between customer and insurer. One ordinary version is a $2,000 car repair with a $500 deductible, leaving $1,500 for the insurer to consider. The practical lesson is that the deductible is not a fee, it is your retained slice of the loss. Higher deductibles usually lower premiums. Under the surface, because you keep more of the small loss risk, the insurer expects fewer or smaller payouts. Think of a homeowner choosing a higher deductible to reduce annual premium. The viewer should remember that saving money upfront means accepting more cost at claim time. Lower deductibles make claims less painful but premiums higher. The practical engine is simple. The insurer takes on more first-dollar risk and charges for that convenience. Picture a driver choosing a low deductible because even a small repair bill would strain cash flow. Once you see that, deductible choice should match emergency savings. Deductibles apply only if the loss is covered. Mechanically, if an exclusion blocks the claim, paying a deductible does not create coverage. This shows up when water damage from an excluded gradual leak being denied rather than paid after deductible. That small detail changes the decision because coverage comes before deductible math. Different coverages can have different deductibles. The process works because auto collision, comprehensive, home windstorm, health, or travel claims may each use separate rules. You can see it when a home policy having a regular deductible and a higher storm deductible. This matters because there may not be one deductible for the whole policy. Percentage deductibles can surprise people. The hidden lever is that instead of a fixed amount, the deductible may be a percentage of insured value. For example, a 2% wind deductible on a $400,000 home meaning $8,000 out of pocket. So the useful takeaway is that percentage wording can turn a small-looking number into a large payment. Health insurance deductibles work differently from many property policies. The moving part is this. You may pay eligible medical costs until the annual deductible is met, then cost-sharing changes. A simple example is several doctor visits and tests adding up before the insurer starts paying more. The result is that health deductibles are often tracked across the year. A deductible discourages claiming tiny losses. What changes the outcome is that if repair cost is close to the deductible, filing may not be worthwhile and could affect claim history. A realistic case is a $550 windshield repair with a $500 deductible creating only a small potential payment. That is why not every covered loss is worth claiming. Deductibles can affect behavior before loss. In real life, people with higher deductibles may maintain property more carefully because small losses remain theirs. One ordinary version is a homeowner fixing minor roof issues early to avoid larger uncovered or high deductible problems. The practical lesson is that retained risk can encourage prevention. The deductible is usually subtracted from the payout. Under the surface, you may not always pay it as a separate bill. The claim payment may simply be reduced. Think of an approved $5,000 claim producing a $4,000 payment after a $1,000 deductible. The viewer should remember that claim checks can look smaller than the estimated loss. Some policies waive deductibles in certain situations. The practical engine is simple. Large losses, specific coverages, or preferred repair networks may have special rules. Picture a glass repair benefit with no deductible while collision claims still require one. Once you see that, deductible rules must be read by coverage type. Choosing a deductible is a cash flow decision. Mechanically, the right amount is what you can comfortably pay quickly after a bad event. This shows up when selecting a $2,500 deductible while having only $600 in emergency savings. That small detail changes the decision because a deductible you cannot pay can make insurance hard to use. Businesses use deductibles to manage frequent losses. The process works because a company may retain predictable small claims and insure against severe disruptions. You can see it when a delivery fleet accepting minor scratch costs while insuring major accidents. This matters because deductibles help separate routine expenses from serious risk. Deductibles interact with claim frequency. The hidden lever is that frequent small claims can raise premiums or affect renewal even if each claim is legitimate. For example, a homeowner filing several minor water claims and facing stricter renewal terms. So the useful takeaway is that using insurance repeatedly for small issues can have long-term cost. A high deductible can make sense for low-probability severe risks. The moving part is this: if you have savings, you may prefer lower premiums and self-fund smaller losses. A simple example is a careful driver with emergency cash choosing a higher collision deductible. The result is that risk tolerance and savings should guide the choice. A low deductible can make sense when volatility would hurt. What changes the outcome is that people with tight budgets may value predictable premiums over sudden out-of-pocket costs. A realistic case is a family choosing a lower home deductible because a surprise repair bill would disrupt rent and groceries. That is why financial stability matters as much as expected math. Before buying, test the deductible with real claim examples. In real life, ask what happens after a cracked windshield, small theft, major fire, storm damage, or medical test. One ordinary version is calculating each scenario before deciding whether the deductible is comfortable. The practical lesson is that numbers become clearer when attached to situations. Deductibles are the boundary between self-insurance and transferred risk. Under the surface, they decide how much pain you keep before the policy starts helping. Think of two people with the same coverage feeling very different after a loss because their deductibles differ. The viewer should remember that choosing insurance means choosing both the protection and the first part you will handle yourself. A deductible is the part of a covered claim you pay before the insurer pays. If your deductible is $1,000 and the covered repair is $6,000, the insurer may pay $5,000. If the repair is $800, the insurer may pay nothing because the loss is below the deductible. This is why small claims often do not produce a payout. Deductibles also affect behavior. A higher deductible usually means you keep more risk yourself, so the premium may be lower. A lower deductible usually shifts more small loss risk to the insurer, so the premium may be higher. The best choice depends on your cash cushion. A cheap premium can become painful if you cannot afford the deductible during a claim. Different deductibles can apply to different losses. A health policy, car policy, home policy, or natural disaster section may each work differently. Some deductibles apply per claim. Others may apply per year or by percentage. That is why the number alone is not enough. You need to know when it applies and how it is calculated. The takeaway is that a deductible is not a fee for buying insurance. It is your retained share of the risk. Before choosing a policy, ask whether you could comfortably pay that amount tomorrow if something went wrong. Insurance works best when the deductible is high enough to keep premiums sensible, but not so high that a claim becomes unaffordable.